Assalamualaikum warahmatullahi ta'ala wabarakatuh. So we have to move on to our first topic, so introduction. And first of all, we have to understand what is finance. So in terms of the definition, so what is finance is actually the application of principles of financial economics to an interrelated of a set of monetary problems. So basically, what is finance is actually refers to the monetary problem. So when a company or a person they have the monetary problems, and then how to solve the problem, they have to apply for the principles of financial economics, right? So basically we have three categories over here. So we have the personal finance, public finance, and corporate finance. Personal, it means that refers to our individual. Public finance refers to the government, and then the corporate finance refers to the company. Alright, so what is the financial management? So in order to make it simple, it's actually how suppose we manage our financial. So what suppose we manage is actually what suppose we do. We have to study, we have to practice the money related decisions within a firm. And for your information, I'm going to make you clear that what we're going to study is actually more on to the financing of a company. Alright, it relates to, so if the how supposed we manage our financial is actually we supposed to manage our activities that concern with planning, and then we have to control our financial resources, alright, and then we have to make sure that it will be balanced, the risk and the profitability. So it means that here, in order to manage our financials, so we have to plan properly, control, and then also we have to make sure that the thing is between the risk and the profitability also we have to analyze. So these are the decision functions that we have to understand. So what are the areas of the decision that you have to make? Right, number one refers to the investment decision. So the decision, for example here, to determine the total amount of the asset needed, right? So for example, it's a company what want to invest in certain things. So what you have to decide is in terms of the decision. Number one is, alright, if the capital investment decision, so it means that here, so there is the wording of the capital. So capital, it involves a large sum of money, and it is non-routine. Okay, so when it involves with the capital, it means that big, huge or something. So this one is going to involve a lot of money. Alright, working capital investment decision is actually less than a year because it refers to the working capital. Alright, so this is more routine, usually takes place on a daily basis. For the capital, it's a long term. For the working capital, it's normally less than a year. So these are the decisions that you have to make before you make an investment. Is that a routine or is that non-routine? Alright, number two is actually the financing decision. Alright, so it means that you don't have enough money, how you would like to invest. So where suppose the money that you can get from? Alright, number one, you can borrow. Number two, capital by issuing common stock or ordinary shares, or you can also offer a preference shares, right? Or you can use your retained earnings. So it means that for a company, you have to decide, right? Whether you want to issue new shares, you want to issue preference shares, all right, or whether you want to use the retained earnings. Number three is asset management decision, all right? So this one involved with the management of current asset. So what is related with the current asset? Current asset, that's we have the inventory of stock, and then we have the account receivable and so on, right? So this is the decisions that relate with the asset management. All right, so next one, important parties in the financial environment. So who are the important parties that is going to be relate in this environment? All right, number one is a financial manager. So who is a financial manager? So the person who responsible to decide or deciding on how much to invest in the firm funds for expanding business. So it means that they have to decide how much they are supposed to invest in the company to make sure that the company can be expand. All right, and then how to obtain funds for an investment. So number one, they have to decide how much they need for the fund, and number two is how to get the fund. All right, number two is the investor. All right, so investor, for they can purchase the securities or what we call shares and everything. All right, next one is institutional. So investor come from individual, is come from the institutional. So it means that, so this is for a big firm and so on. All right, so what they do is to provide loan, and also they also can purchase of the shares, right? All right, now we move on to the third one, which is the financial market. All right, so we already covered the number one and number two. All right, number three is the financial market. So what is the financial market? It's actually a place where the forum that can facilitate the flow of funds among the investors. So it means that here, so this is the place where the investors traded their investment. All right, and then next one is composed of money market and capital market. So we have two, money market and capital market. Money market is actually for a short term, less than a year, and capital market is actually for a long term, more than 1 year. All right, number three and number four, next one is the financial institution. So what is the financial institution? All right, it's actually intermediaries that channel the savings of the individuals, businesses, and the governments into loans or investment. All right, so it means that here, the financial institution here, it become the intermediate between the individuals, businesses, government, and so on. Right, I give you specific example. For example, you know what is the commercial bank, some sort like the Malayan Banking Berhad, Bank Islam Berhad, and so on. So they act as the intermediaries between who? Between the person who want to, they have the extra money they put inside the bank. So what the bank will do, for those who really needs the money, they will give loan to the other people. So what they act is actually as the intermediate between the two parties, the borrower, and also for those who really need loans, and also for those who have extra money, they will keep it in order to give to the person who really need the money. All right, next one include commercial bank, just like what I said just now, saving institution, right? For example, EPF, right? The insurance company, finance company, and also mutual fund. All right, so now we go into detail. So what is actually the money market? So it's actually what I informed earlier, is a short term. So such as a commercial paper. Commercial paper is actually the loan given by the company, established company, not the bank. All right, and then the banker's acceptance, money market funds, certificate of deposit. All right. All right, number two is actually the transaction normally take place over the phone. So it means that it's quite easy. By right, is actually we can use internet. All right, number three plays an important role to the commercial bank, in that is enable the bank to convert a portion of their cash reserve into assets that generate returns. All right, so it will give the commercial banks to make sure that they can convert the portion of the cash reserve, all right, in order to get the generate return. So it means that here you can save your money in a certain things, make sure that you can get return from the investment. All right, number four, facilitate firms and institution in obtaining short-term loans. All right, so this one also will give for those who really need money in a short term, for example, less than 12 months or less than a year. All right, so what is capital market? So capital market is actually security have a life of more than 1 year, such as ordinary shares, and then preference shares and bonds. All right, so preference shares here, you don't confuse us. Some of us traded for a long time, means that more than 1 hour, more than 1 year, and some of us they buy and sell within a short-term period. Alright, number two is categorized into primary market, and number two is a secondary market. So what is the primary market? So primary market is actually new securities or new shares are bought and sold for the first time. Alright, so the issuer is directly involved in the transaction and receive the proceeds from the sale of security. Alright, so this one primary market, for example, before this we have Ayam Sendang Berhad. Now they would like to convert their company, move to Berhad. So they would like to sell their shares at the first time. So this one, normally for those already the slip of the bank at the bottom of it, they said that how many ringgit of shares is being offered in the what we call if you go to the ATM machine, you would like to take your money, you have the receipt. So normally sometimes they advertise at the bottom of the receipt. Alright, so that one we call it as a primary market. I repeat back again, primary market, it refers to bought and sold for the first time. Alright, the company do not trading their shares to the public yet. Alright, secondary market, where existing securities or existing shares are traded among investors. So it means that here the investor can buy and sell among themselves. So this one refers to Bursa Malaysia, alright, and also Malaysian Derivative Exchange. Alright, so this one, okay, capital market. Alright, so what is the responsibilities of the financial manager? Now we are going to have a look. Later on, if you are being appointed as the financial manager, so what are the responsibilities that you have to face? Alright, number one, forecasting and planning. So it means that you have to forecast for the future, you have to plan for the future. Alright, for example, determine the amount of funds the firms need. Alright, a large firm seeking rapid growth will require more fund. Alright, for example, the bigger company, they need more fund. So basically, you as a financial manager, you have to know, how much the amount, determine the amount that the firms really need in order to make it growth. Alright, number two is investment and financing decision. Alright, so number one, you have to determine the sales, the growth rate or sales. For example, every year, the percentage of sales and so on. Alright, number two, determine what specific asset to purchase. Alright, so what are the things that you need to purchase to make sure that you are going to invest for the company. Alright, number three, determine the best method of financing those assets. Alright, for example here, if the company ABC Berhad, alright, for example, this is the holding company, they would like to open a new branch, for example, in the Klang Valley, for example, alright, so they need fund, alright. So what is the best method to finance this asset? Number one, for example, I just give an example whether they would like to issue shares, alright. Number two, whether they can issue the preference shares, and then number three, whether they can issue debt. Alright, so the financial manager has to define this kind of decision. Alright, number three, so what else? The responsibilities, the coordination and control. So you have to interact with other departments within the organization, right? For what reason? Because the decision of other departments might affect their investment decision. So it means that you have to coordinate all those departments that you have in a company to make sure that you are in a right track. Alright, number four, dealing with the financial market. So here, what you have to do is you have to obtain the financing either through money market or capital market, whether short term or long term. And then you have to decide on investing either funds in the financial market. So it means the extra fund that you don't use, So how suppose you make in the decide on the investing or invest in something. All right, then next one, the last one is to foster relationship with the creditors. The financial manager's decision affect the shareholders' wealth maximization. So it means that here, whatever the decision of the financial managers will affect the shareholders' wealth. Number one is the current and the future earnings per share. I think that you already understand what is earning per share. So it means that here for one share, what is actually the earnings. Alright, number two, in terms of timing, duration, and risk of earnings, right? So this one also will be affected. Number three is the dividend policy, and number four is manner of financing. So this one, whatever the decision of the financial manager, it will affect the shareholders' wealth maximization. So for example, I give you the real situation. Is one share, all right? The price is RM 20 ringgit, and then the other one is one share if the price is according to 2,000 ringgit. So this one, the wealth of the shareholders will be more, all right, because one share they can get 2,000, but this one share they can get only 20 ringgit, right? So it means that here, so if they have the decision on the four items here, so that one will affect the shareholders' wealth maximization. Right, now we move on to the goal of the firm. Alright, so what is the firm's goal? Alright, number one is the profit maximization. Number two is the shareholders' wealth maximization. Alright, whether to maximize on the profit or whether to maximize on the shareholders' wealth. Alright, so profit maximization, so it's actually how to maximize the profit. So everybody understand already what is the maximize of the profit. So now we go on to the profit. So what is the profit? Is actually amount of revenue remaining after deducting all costs and expenses. So this is how to get the profit. All the profit we minus the expenses. Alright, so these expenses include non-cash items such as depreciation and amortization of fixed asset. And please do remember, when we calculate profit, we also minus the non-cash items such as depreciation. Alright, hopefully you can remember this one. When we do our financial statement, we minus the depreciation in order to get the profit. Alright, number two, alright, number one finished already. Number two can be achieved in short term. Alright, so profit normally we calculate for yearly profit. Alright, by either increase or decreasing the variables such as sales unit or a sales price. So this one can be achieved less than a year. Alright, if we increase our sales, alright, so if we decrease our variables, okay, so this one will increase our profit. Alright, number three, emphasize on the amount of profit. Alright, we just calculate how much is the profit that we are going to receive, but we do not concentrate when the profits are received. For example, the transaction is actually done in December, but the money received in January. We still consider that the transaction is, we recognize the profit is on the December. Alright, we do not cater when the profit are received. Alright, number four, increase in profit does not mean increase in cash. So this one in financing, cash is very important. Alright, so increase in profit, not necessarily the company have more cash, right? So number five, this one ignore risk. We do not cater other risks that we have to into consideration, and also we do not cater any uncertainty that comes with the project. So this one we ignore. So these are the drawbacks or disadvantages of profit maximization. Alright, so what are the advantages? Number one is a short-term concept. So it must be achieved within a year. Alright, it's only for a short term. Alright, so give an example here. For example, a company intend to increase its profit only for that year. Alright, either by reducing its investment in R&D. So they have two things that they would like to focus. either by reduce the R&D, right? The other one is by postponing their major repairs. So the reduction, the R&D or postpone the major repairs is actually, it will affect the future profit, alright? But they don't care. Even though for that year they would like to achieve more profit, even though they reduce the R&D, but it's actually if they focus more on R&D now, so it means that they can make the profit in the future. But the target for the current year, they would like to have more profit. So this is a short-term concept, which is not good. Alright, or the advantage of the profit maximization. Alright, number 2, does not consider the timing of return. So it means that here, timing of return refers to how quickly a firm earn a return from an investment in a fixed asset or non-current asset, right? So we would like to see how fast they can get back their money. Alright, assuming a company has 2 projects with the following earnings. Alright, so we have project A, we have project B. For year 1, you have 250, year 2 you get 0, total 250k. For project B also, year 1 is 0, year 2 is 250k. Alright, so the profit maximization, as long as the profit is 250, so that one is already good enough. So both projects are the same. But in terms of drawbacks, we have to see how fast that the company can get back the return. So in this situation, the project A is better. Why? They can get the return in year 1. After they receive the return in year 1, they can make an investment ready of the 250k. But for the project B, they have to wait until the second year, they can get the 250k. For company A, they can make investment ready with the 250k. Next, alright, just like, so this is the explanation of just now, of the slide just now. So according to profit maximization, project A and project B is equal, right? Since both projects generate the same earning, which is 250k. But according to the time value of money, the two projects are not equal because A received the earnings sooner, right? Soon as possible, A receive first, and then they can invest, and then they can get a higher value of money. Alright, number 3, so the drawback of the profit maximization, they does not consider risk. So what is risk? Risk is actually defined as a chance that the actual result will be differ from the expected result. So what do what you expected and the actual result is not the same. So this is what we call risk. For example, you expect that you will get an A in the, for example, mathematics, but actually when it comes to the real result, you got C, right? So that is the risk. What the difference between what you expect with the actual result. Alright, so next one, assume a company is considering two mutually exclusive project. Mutually exclusive project means that you have to choose only one with the same project, alright? Okay, so it means that you have to take one and then you have to drop the other one. Alright, so project A, we can see here from the economic condition for boom, average, and recession. So everything is maintained, 300k, 300k, 300k. What about project B? During the boom, they got the 700k, and during average is 200k. So if we total up, so both will give you 900k, but in different economic conditions. So this is so we can see which one is the risky project. Is actually project B. Alright, so project A is a moderate. So every economic condition, they will give the same earnings. Alright, according to the profit maximization, the two projects are equal since the average for both projects are 300,000. Total are 900,000 divided by the 3 economic condition. so it can give you 300,000 basically. But the two projects are not equivalent because project B has the high degree of uncertainty. It means that risky compared with the project A. So project B may not be able to generate earnings if the economy is in the recession. So during the recession, the company got nothing. Alright, so next one is the shareholders' wealth maximization. Alright, so how to maximize the shareholders' wealth. Alright, so shareholders' wealth is actually refers to the market value of the common stock or the market value of shares held by the company. If the value of the shares increase, then the shareholders' wealth will be increased. Alright, has to achieve all the short-term target first, alright, such as increase in profit and then growth in earnings, dividend, maintain financial stability so that the firm can be more attractive, resulting in increase in demand. So if the shareholders, they see all these things, for example, the profit is good, the growth in profit is good, dividend is good, the stability of the financial company, the stability of the company is good, then they become more attractive. It means that they would like to purchase the shares in the company, right? So the firm's common stock will follow with an increase in the share prices. So when the demand is high, of course, the price also will increase. Alright, number 3, apply the principles of time value of money, which a dollar received today is worth more than if it is received in 10 years' time. So it means that here we have to consider the time value of money. Received earlier is better compared with received later. Alright, number 4, decisions are made after taking into account the uncertainty or the risk factor. So this one, you consider the risk factor. Alright, number 5, increase in wealth is actually increase in cash. But for the profit maximization, it's not necessarily increase in profit. It does not necessarily increase in cash. Right, now we have to see the advantages and disadvantages of the profit maximization. So the profit maximization also, we have the advantage and disadvantage. Alright, number 1 is easy to calculate profit. So how to calculate profit? Sales minus all the expenses, we can get profit ready. Alright, number 2, easy to determine between the financial link, determine the link between the financial decision and the profit. So we can see the decision and the profit. So the decision here to maximize profit. So we can see easily. Alright, number 3, stress on efficient use of the capital resources. So you can use that the most capital that we already use in order to get more profit. Alright, these advantages is only a short-term target, alright, for that particular year in order to get profit. So we already receive our target. Alright, ignore risk. Okay, real world complexities when making financial decision. Alright, so it means that here in real world is really complex in order to make a financial decision. Alright, so this one is concentrate on the earnings, on the total earnings. Alright, ignore cost of fund provided by the shareholders in computing profit. So basically here, to make you understand, when the shareholders give their money, put their money inside the business and then it's being run by the company, they want a certain return or dividend from the company. So if the dividend is not competitive, the shareholders will sell the shares and buy from another company. Alright, so this one, under profit maximization, they just ignore about the cost to maintain the shareholders in the company. Alright, next, the last one. So what is the advantages and disadvantages of the shareholders wealth maximization? Number 1 is emphasize long term, alright, and then is consider risk of uncertainty and so on. Number 3, timing of return or time value of money just now. Right, number 4, taking into account the economic expectation since it affect movement in stock price, right? So this one we consider also what be the expectation in the future, because it will affect the share prices. And then we concentrate on earnings per share, right? So it means that here for one share, what is actually the earnings for that. Right, so what are the disadvantages? All right, number one, so gold does not offer any clear relationship. You can see the relationship between the decision, the share prices, and also the decision taken by the company. All right, number two is a long time to achieve, just like what I said before. So we have to see the profit, we have to see the stability of the company, we have to see the growth of the company, and also so many things that we have to look on in terms of dividend also. So it means a long time to achieve. Alright, so maximize earning per share. So the firm may have to implement a dividend policy. Alright, so you have to see also the dividend policy that is going to be implemented by the company. And sometimes the dividend policy may never pay dividends. So this one we are going to be further in other math subject during the degree program. Alright, okay, thank you.